You do not often encounter alerts that rise to the level of sheer urgency. You do not often find yourself pausing mid-morning, caught by a tremor of significance, as though the financial currents themselves have shuddered. That's exactly what's happening right now, and if you hold Vietnamese Dong or Iraqi Dinar, if your eyes have lingered over the acronyms VND or IQD trembling in your portfolio, you need to listen closely. In the past 48 hours, unseen forces have aligned. Market structures, geopolitical tensions, inflation benchmarks, central bank rhetoric, all have converged into what can only be described as a massive move in these currencies. It is as if the financial world held its breath and now exhaled through a sudden shift. The implications could reverberate through dwellings and boardrooms alike. This is urgent, this is serious, and this is the moment you must not ignore. The Vietnamese Dong and the Iraqi Dinar have been relatively steady for years, bound by rigid central bank policies, rendered almost static compared to their more mercurial emerging market cousins. That at least has been the accepted narrative. But beneath that narrative, the tectonic plates have been in motion. Economic pressures in Southeast Asia and the Middle East haven't shifted overnight, yet the signals, some subtle, some glaring, have now collectively broken through the threshold of complacency. Today there are whispers, now turned to murmurs, now becoming a roar. The Vietnamese Dong, long managed to a tight peg, now finds its tether under strain. Currency traders are waking up to uncharacteristically heavy volumes. On electronic trading platforms, bid-ask spreads for the Dong are widening. Offshore rates deviate materially from onshore banks. That is not typical. That is not convenience. That is stress. That means there is pressure from speculators, from institutions, from exporters, from importers, from nervous financial actors who sense that central bank defense may be faltering. That means you need to pay attention. Simultaneously, on the other side of the Indian Ocean, the Iraqi dinar, long dismissed in some investor circles as languishing in a haze of political uncertainty, shows signs of life. Demand for the dinar has quietly ticked upward in some trading centers in Baghdad and Erbil. Market chatter, typically confined to risk-paranoid web forums, now ripples through credible banking desks. Official communication has not budged. There is no headline quoting the Iraqi central bank. Yet silence can now carry meaning in itself. When a central bank that typically operates in the shadows of global headlines suddenly stops issuing even its customary daily fixes, that silence becomes a signal. If the dinar is being subtly supported, either through reduced issuance, managed liquidity, or an operative trade agreement in the works, well, notice that. That whisper in the halls is what becomes a roar when the lid pops. If you hold dinar, you have to ask yourself, do you think the static conditions that have constrained movement could soon yield to force majeure? This is more than speculation. This is a brief, telling moment where multiple indicators align. We see trends in commodity prices. Oil, though not surging, has remained firm, keeping inflation forecasts for oil-exporting economies elevated. That reinforces the political will behind control measures. That reinforces the idea that currency defense budgets cannot be infinite. We see shifts in regional capital flows. Southeast Asia is starting to lose some net foreign direct investment momentum, with investors pulling back on cyclicals, while the Middle East sees cautious, possibly preemptive capital accumulation from local sovereign investors. Those are not isolated data points. They connect. On one side, capital leaving. On the other, capital quietly returning or stockpiling. That is pressure, and that is potential. That is change. It's urgent for two reasons. One, because those holding these currencies may be unaware of the magnitude brewing just beneath the surface. If you woke up this morning and perhaps, like many investors, only skimmed official central bank statements, you might assume stability. You might think, the peg holds, the fix is in. Yet the systemic tremors do not always show themselves in words. They show themselves in order books, in electronic spreads, in entity behavior. If you are not watching, you're going to be blindsided. Two, because these are significant currencies. Many people's livelihoods, trade contracts, small business margins, remittance calculations, even travel budgets, are pegged to these. A 5% move in the Dong or dinar may seem small to macro traders. But to small business owners in Hanoi or families in Basra receiving remittances, it's seismic. That is why every single word of this matters. Let me walk you through what's been observed, quietly, in case you aren't watching the live FX dashboards. For the Vietnamese Dong, the official exchange rate has remained, as expected, within its narrow allowed band. The state bank continues to offer the standard daily reference. Yet, across over-the-counter channels, volumes have spiked. The best bids, the rates at which traders are willing to buy Dong, are drifting lower. The ask price, the rate at which they will sell, is firming upward. As of this morning, that divergence has grown beyond a whisper. It is perceptible. Digital trading venues report higher latency and slippage. That means more trading friction. The tenor is one of hesitancy, not necessarily panic, but of caution, and that often precedes acceleration. Similar patterns were seen in Thailand ahead of policy shifts, or in Sri Lanka before currency trimming became outright devaluation. That is not to say Vietnam is devaluing imminently, but the pattern alerts you to tension. In Iraq's case, banking intermediaries report that the dinar is in short supply in some corridors. Buyers, especially exporters needing to convert goods receipts into foreign currency, are seeing diminished liquidity. That could be a function of central bank tightening or a deliberate policy. It could also reflect preparation for a managed recalibration of the peg. Even more telling, there are anecdotal reports of small windows in the Forex markets being closed. That is how defense begins, by reducing access, rations, clawing back excessive availability. A quiet tightening, like turning off taps just enough to see if the flow slows. Market voices from inside say that should normal supply conditions remain disrupted, the ground settles for a possible controlled depreciation, or, in headline language, a peg adjustment. That word, adjustment, always attracts attention. It always triggers movement. It always changes valuations. You might wonder, is this alarmist? Is there really anything confirmed? Fair question. There is no press release. There is no sensational headline. Yet the most important financial moves begin with invisible undercurrents. No economy ever publicly says, "We plan to devalue next week." They move quietly, preparing the backstage, testing the stagecraft. And that preparation is now visible, if you know where to look. If you don't, it's invisible until the curtain rises. Traders who read the smoke signals are now positioning their orders. Many institutional desks show increased skew in forward points, pointing to bets that the Dong or dinar will slide over 3-month, 6-month horizons. That is backed by real executed trades, not just promises. And that is not speculation. That is behavior. That is why this broadcast cuts through the background hum. If you are a holder of Dong or dinar, your response must be measured, informed, urgent. Panic would accomplish nothing, but disbelief or inattention would be dangerous. You need to assess your exposures. How much of your liquidity resides in these notes? Are you a business that collects or pays in them? A remittance sender or receiver? A corporate with contracts denominated? You must quantify your exposure. Then you must decide. Do you hedge? Do you stagger your conversions? Do you buy a foreign exchange swap? Do you shift some holdings temporarily into hard currency instruments? What is your risk tolerance if the market jolts? Because this moment might carry you there. You are not reacting to headlines. You are responding to market behavior. That is how professional traders, staunch money managers, even state-level treasuries must think. The same discipline now in your hands if you hold these currencies. One more point. Pay attention to broader regional signals. Vietnam's trade surplus has slipped, cost pressures are elevated, consumer inflation is firming. Vietnam's central bank minutes, where they still exist, have morphed in tone over the past month, from monitoring inflation to prepared to act as necessary. That is not benign. That is code. In Iraq, the oil for reconstruction cash flows remain tenuous. Export proceeds are patchy. Revenues remain short of budget targets. Any cut in subsidy or policy shift could tilt public finances and force a policy pivot. Foreign exchange reserves are not flooding. That means tools are limited. And when tools are limited, markets sense it. that gives rise to cautious support